A market crash is a fast, large, disorderly fall in prices, and it almost never has just one clean reason behind it. By the end of this, you'll see why a normal pullback can flip into a cascade, and why the moves that actually protect a private investor happen before the cascade starts, not during it. Overvaluation. Every crash needs a setup, and the setup is almost always the same. Prices have been climbing for years, and at some point you stop paying for what a company earns today and start paying for an almost perfect future. The market even has a name for this: priced for perfection. The tricky part is how this feels from the inside. Things that keep going up start to feel safer, not riskier. But quietly, they've become more dependent on everything working out. So when reality lands somewhere between okay and pretty good, instead of flawless, that premium for perfection burns off, and the price has to fall just to match normal results. Nothing actually has to break for this to happen. For a private investor, the lesson is uncomfortable but useful. A rising chart isn't proof of safety. It just means the price now has more to defend if anything wobbles. Hold on to that, because this fragile setup matters a lot more once the amplifiers show up. But before the amplifiers, something has to actually push. Economic and earnings shock. This is the first kind of push. Something real happens to the businesses behind the prices. A recession warning, consumer demand slips, costs spike and quietly eat the margins. Remember, a stock isn't a ticker symbol on a screen. It's a claim on years of future profits. The moment those expected profits get cut, the value of that claim gets cut with them. Where beginners stumble is treating every scary headline as a crash trigger. Most aren't. A headline only moves the market when it changes one of three things: expected profits, the cost of money, or how much risk people are willing to hold. If a story doesn't change any of those, it's noise. So instead of asking, "Is this scary?" ask, "Does this actually change what these companies will earn over the next several years?" That one question filters out probably 90% of the panic in your feed. Interest rate shock. The second kind of push doesn't touch company profits at all. It changes the price of money itself. Think of it as the gravity of the financial world. When safe interest rates rise, money you'll receive in the future becomes less valuable today, because in the meantime, you could just sit in cash and earn something. This is the discount rate, and it quietly reprices everything. A company can be earning more money than ever, and its stock can still fall, simply because the rate used to value its future profits has gone up. This is why stocks, bonds, real estate, and mortgages tend to move together when rates jump. They're all priced off the same gravity. So treating rates as a topic for economists is one of the more expensive things a beginner can do. Rates quietly set what your portfolio is worth in today's money. But here's the thing. Everything we've covered so far, overvaluation, earnings shocks, rate shocks, that's still just a decline. To get a crash, you need something else. You need amplifiers that turn ordinary selling into a stampede. That's the next 5 blocks. Leverage and margin calls. This is where voluntary selling becomes involuntary. And it's the cleanest example of how the market itself amplifies a fall. When investors borrow money to buy assets, they pledge those assets as collateral. As prices fall, the collateral shrinks. At some point, the broker stops asking politely and starts selling. The leverage investor doesn't choose the timing, doesn't choose the price, and often doesn't even get enough warning to react. The beginner script writes itself here. Greed buys the position, confidence shrugs at the risk, and then a falling chart quietly hands the controls over to the broker. That comforting line, "I'll just sell if things get bad," assumes you're the one with the sell button. With leverage, you're not. The practical edge is unglamorous. Avoid margin and leveraged products unless you can ride out a deep drawdown without being forced out at the worst possible moment. Discipline here gets built before the trigger arrives, not during the panic, because during the panic you don't have the time, and you may not even have the choice. Liquidity vacuum. Most people picture a crash as too many sellers. The more accurate picture is that the buyers step back. Every price you see on screen exists because someone somewhere is willing to take the other side at that level. When fear spreads, those willing buyers move down the ladder or just disappear from it. The next real buyer might be 5% lower, or 10, or 20. The seller who needs out has no choice but to accept that lower price, and the screen gaps down. This catches a lot of beginners. They use a market order or a stop loss during stress and expect to exit somewhere near the last quoted price. In a vacuum, the last quote is a memory, not a promise. Stop orders can trigger and then fill far below where you pictured. Think of liquidity as the exit door. During a crash, the door is narrower than usual. This is also why cash on the sidelines doesn't magically rescue the market. Having money exists in a completely different system from having buyers willing to step in right now. Panic and hurting. By this point, selling has stopped being about valuation, earnings, or rates. It's about pain. The investor watching their account drop isn't selling because the math changed. They're selling because watching it hurt became unbearable, and clicking sell makes the hurt stop. That single click feels like control. What it actually does is lock in the loss at the worst possible moment and add one more seller to a market already short on buyers. And the cruel part is, it feels completely rational from the inside. I'm protecting my capital. I'll buy back lower. Almost no one actually buys back lower. They wait for confirmation that the worst is over, and by the time that confirmation arrives, prices have already recovered. This is the feedback loop. Pain creates selling, selling drops the price. The lower price creates new pain for someone else. If you recognized yourself here, you can admit it in the comments. No shame. The market has seen worse. The edge here isn't to be braver during a crash. It's to have written your rules, your allocation, your cash reserve, your rebalancing plan while you were calm. So that during the storm, you're following a plan instead of writing one. Credit and funding stress. Underneath every market sits a layer of financial plumbing. Banks, lenders, money markets, the daily flow of short-term cash between huge institutions. You don't see it, but it's running constantly. When confidence cracks in that layer, lenders stop trusting each other. Short-term funding gets harder to roll over. Big players suddenly need cash fast. And here's the uncomfortable detail. They don't sell what they want to sell. They sell what they can sell. Typically the most liquid stuff, high-quality stocks and bonds. That selling has nothing to do with what those assets are worth. It's purely about raising cash right now. For a private investor, the unsettling truth is that your portfolio can fall sharply because of a problem 2 systems away from you. A money market strain, a bank under pressure, a fund forced to meet redemptions. You won't see any of this on a stock chart. The signals live in credit spreads, funding markets, central bank emergency programs. You don't have to track those yourself. But knowing this layer exists is what explains how nothing fundamental changed and my portfolio just dropped 15% can both be true at the same time. Contagion. The last piece answers the question that confuses almost every first-time crash witness. Why is everything falling, even things that have nothing to do with the original problem? When investors take losses in one place, many of them have to raise cash. To raise cash, they sell what they can, not what they want to. Healthy assets get sold to cover damage somewhere else. Funds cut risk across the board. Correlations that looked low during calm markets snap close to 1 because in that moment, everyone in the world is doing the same thing. Selling whatever still has a buyer. And this closes the chain we started with. A fragile setup made the market expensive. A real or financial shock kicked off the repricing. Leverage forced involuntary sellers through the door first. Liquidity narrowed. Panic widened the loop. Funding stress pulled in the institutions. And contagion carried the move into assets that had no role in the original story. Knowing all of this doesn't hand you a crash forecast. If anything, it shows why precise forecasts are almost impossible. What it gives you is something more durable, the moves that actually protect a private investor, using less leverage than you think you can handle, holding cash you don't have to touch, accepting that diversification will look broken for a few brutal weeks before it starts working again. Those are all decisions made in calm weather. By the time the cascade is running, the system is no longer asking what you'd like to do.